Hi there, and welcome to our latest video chat in the Money Show Expert Interview Series. I'm Mike Larson, Editor-in-Chief at MoneyShow, and today I'm speaking with Kenny Polcari, Chief Market Strategist at Slatestone Wealth. Kenny, thanks for stopping by to talk.
Always a pleasure, Mike. I love talking to you. What's going on?
Hey, well, what's going on is a great question. What is going on in this market, right? I mean, we've had this amazing start to the year for a lot of technology stocks, the AI names, all of that kind of thing, but a pullback more recently and some, those concerns about breadth in the background. So what are you seeing going on right now?
Well, so I see a couple of things. First of all, yes, we had a great first half of the year, but we're also at the end of the second quarter, right? We've got 4 or 5 more trading days till the end of the quarter. And so what I'm sensing and what I'm actually hoping happens is there's going to be a reallocation, right? Some asset managers are going to have to rebalance portfolios. They're going to have to take some money off the table. And some of these tech names that are so stretched that because some of them are up triple digits.
Yeah.
And so good risk management just says, listen, you got to trim the position up triple digits. You got to trim some of the position and then take that newfound money to reallocate it to other sectors that I think are going to now outperform, as it appears that the Fed may in fact have avoided a crash landing, which I kind of thought they were going for a crash landing. And I'll be the first one to stand up and say, maybe they managed a not so much of a crash landing, but not necessarily a soft landing. So someplace in between. So I think it's very possible that happens. And then I think the market's okay, right? I think the market feels like it's gotten used to that. It understands where we are. It understands even if we have a 1 or 2 more rate hikes, the market does not seem to be panicked about it at all. So I'm actually bullish on it, but I'd love to see the S&P and the NASDAQ pull back a little bit, because if you look at them on a chart, they've gone straight up. And that, as you and I both know, is completely unsustainable.
Yeah, let's talk about that a little bit. I mean, the two scenarios you see that the Twitter already arguing about is we're going to have the market catch up to tech. Essentially, tech's going to take a breather, and all the other stuff is going to play catch up, or the tech sector is going to catch down to what the rest of the market's doing, and it's just another bubble and blah blah blah. So, how do you see that sorting out?
So I think it's going to be a combination. I actually think tech is going to back off, and I think the others are going to. I don't think it's going to back off all the way down to, the Dow's up 2%. Do I think tech's going to back off to up 2%? No. But I think if we see tech back off into the, maybe it's the high teens or low 20s, but then I see the S&P raising its head. It's already up 13%, but the SMIDs, right? The small and mid cap names, transportation names, and the Dow Industrials, I think will catch up. And when you think about the Dow, I think out of the two, it's really the industrial sector as well as the kind of the small and mid cap. So you're really lagging behind, right? Yep. You've got healthcare lagging behind. You've got utilities, although they're lagging behind. That's for a reason, though. If the market, if investors feel great about the market, then they're not necessarily going to rush right out to buy utilities just because they're kind of boring and not so sexy, right? Like some of the other names.
Sure.
But that doesn't mean they shouldn't have a place in someone's portfolio. They probably should, just to offer some stability. And look, they're good dividend payers. And while you can say, well, you can get CDs that are going to pay you 5%, or 2 or 3 month or 6 month treasury is going to pay you 5%. That's all well and good, but there's a time commitment to that. The 12-month treasuries, you have to stay in there 12 months. It's not liquid. Sure. If you take your money out, you're going to get penalized. 3 and 6 month treasuries, you got to roll them for the whole 12 months. They're at the 5%. In utilities, you're going to get still exposure to stocks, but you're also going to get paid handsomely. They're paying 4.5% broadly across the board, and you still have equity exposure, and you have liquidity. You want out, you can get out in one day with no penalty.
Let's talk a little bit about the Fed here. I mean, we all know, you've been following the Fed forever. The ability to hit a soft landing. I mean, what is it? They've gotten like 1 out of 6 or something going back the last few decades. What do you think they did right here, or how do you see this landing scenario playing out for the rest of the year?
Well, I was the first one to think that they were going to navigate a crash landing. I just thought that there was, they had gone way too long. And I still think they went on way too long in terms of stimulating, right? But I think Jay Powell had to keep his job. I think there was a lot of reasons there why he continued to stimulate, because the minute he got his new job, that's when he started. He changed his tone and started to cut, right?
Yeah.
As well as shrinking the balance sheet. It's bigger than it's ever been, and so I was concerned about the pace at which they were going to do that. It seems to me that while Jay Powell was aggressive, and he could have even been more aggressive earlier in the season than he was, even raising rates at 75 basis points. There were times there in January of 2022 when he should have gone a full 1 point, in March, a full 1 point. He should have been a little bit more aggressive. But that being said, it feels to me like they've gotten it to a level now where the terminal rate between 5 and 5.25% is just about kissing the CPI rate, right?
Yeah.
And we know that we always want the terminal rate to just be a little bit better than CPI. So if we get one more rate hike, or if we see CPI now next month come down below that terminal rate, then I would say that he's done a fairly decent job. I will say I have to give him some credit because I was the first one to say that, he was going to screw up.
Yeah, no, trust me, I get it. It's paid to be skeptical of the Fed's ability to
Yeah.
nail that thing. So,
Yeah. Well, because
let's
listen, then you've got all this conversation. You've got 10 different members of the Fed. Everyone's talking different. Loretta Mustard talking about 6% rate. Jimmy talking about 7% rate. Ralphie Bostic saying, no, it's time to wait. And the other one saying, no, we've done enough. So there's this conflicting conversation and narrative out there, which certainly doesn't help investors in the market. That creates kind of angst and volatility. Okay, it is what it is. But as a long-term investor, some of that stuff, as you know, is really noise. And so you got to learn to eliminate the noise and focus on the plan.
Let's talk a little bit about this geopolitics stuff. I mean, I don't really know what just happened in Russia. I'm not sure anybody. Do I call it a coup, a mutiny, a stage theater? I don't know. But we have whatever's going on over there. We still have the saber rattling between us and China over Taiwan. Do any of those things really concern you in terms of how they could impact markets later this year?
The only one that really, listen, I'm concerned about all the kind of the unease in the world, because that's always a little bit concerning, especially now with what happened in Russia. Russia is one of the nations that's got a very large supply of nuclear weapons, and that just makes me a tad bit nervous. But the one that I'm more focused on, and even though it may not price stocks in the long term, it will certainly add to short-term volatility, as you know, is the China-Taiwan thing. I think Xi Jinping has made it very clear that he wants to restore China the way it was, almost the same way Vladimir Putin wants to restore Russia to the USSR that it was when you and I were kids, right? But that Xi Jinping wants to reach out and grab Taiwan. And I think that's a problem because, as we know, so much is manufactured in Taiwan that the world depends on. And now then it becomes under complete Chinese control. And I think that's an issue, right? Which is now why we're seeing, Intel building a plant, in the United States and Ohio. Okay, that's great, except it's not going to be ready for 2.5 years. Okay, great. If Xi Jinping takes Taiwan next month, we're screwed, right? The world is really screwed, not just U.S. I mean, it's a global phenomenon. So that concerns me. But all that will do is create certainly some short-term volatility. But as you know, as that short-term volatility, it creates opportunity if you have the stomach, right? If you don't panic and, oh my God, you sell everything. If you have the stomach, I think it can create some opportunity. But yes, those two issues and all kind of geopolitical unrest is a little bit concerning. But I think investors recognize that in the end, what prices stocks is profits, profit margins, economic, the economic climate, the economic cycle that we're in, much more so than politics.
Sure. Now you're going to be speaking for us at the Investment Masters Symposium in Las Vegas. It's coming up in August, and really excited about that. And one of the things your topic's nominally, I know things can change, was going to be the Fed, the election, the markets, and you. We've covered 3 out of 4 of those, I guess, but the election is the other thing looming out there. We're still far away from the actual vote, but how do you think the election, and thinking about that's going to factor in on Wall Street in the coming quarters?
Well, it's like anything, right? Once it starts to crystallize and you get a sense of who's really rising to the top, and you get a sense of what their positions are on different regulatory items, on banking, on whatever, on taxes, on all that stuff, then you start to kind of play it. Now, it's still far out. To your point, we're a year out. Even though I'm going to Vegas in August and the election's not until November of 2024, the fact is you're going to start to see it crystallize. And look, we're going to have that first debate. I think that first Republican debate takes place in September, doesn't it? I think
that's around there. Yeah.
I think it's September. And there's a lot of people. I mean, what is there? 18 people in the Republican field? And a lot of them are polling at 1% and 2% and 3%. So, I think that we're going to see a lot of them bow out very early on. And that will allow the dark horse to come to the top. Because I got to tell you something. I am not convinced, no matter what's happening right now with Donald Trump, I am not convinced that he's going to be the candidate by any stretch. I think there's a dark horse that is yet to show his face. And I think that's going to play into a lot of not only what happens to the tone and sentiment in this country, but what potentially that could mean for the markets.
Gotcha. Let's go back to the markets here before we wrap things up. So if you had to boil down your advice for, between now and August, when you're going to have a chance to kind of refresh your view to the people that are watching and listening to you through Money Show, what is your advice for people here?
So I think you have to be prepared for kind of a weaker summer, but weaker doesn't mean a disaster. Weaker actually means that I'm hoping that the market pulls back a little bit, right? I think if we trade back down to, 34,000, 3950-ish, that would actually be a great pullback. It would be about 6 or 7%, which is certainly well within the trading, bands of what's considered normal. But I think that's what you have to be prepared about. Look, I think you have to pay attention. There's one more rate hike in July. Then August is a vacation because there's the big Jackson Hole boondoggle. And then we have the September rate hike, right? And now I think it's going to be a rate hike and not a rate cut, the way the market had been pricing in. And even though I think that narrative is out the table, I think J.J. Powell has made it very clear. You got to get cut out of your head. It's not happening this year. I think that, if we get one hike in July and then we see how the data is in August and September before the next Fed meeting, I think then you'll get a better sense. But look, as you and I also know, the fall can also be an interesting time in the market. September and October tend to be volatile months anyway.
Sure.
And then we have that Santa Claus rally into the end of the year. But it's about, as a long-term investor, staying focused, right? Sticking to the plan, using dividends to reinvest in names that you like, and not panicking if stocks get dislocated. If the fundamental story of that stock that you own hasn't changed, then a dislocation and a pullback in the name may be nothing other than a dislocation in the name, right? Big asset managers need to raise money real quick. How do they do it? They hit the sell button, they sell the big mega cap name. Doesn't necessarily mean Apple's fundamentals have changed. They haven't. I would love to see them, crush Apple a little bit, or Microsoft, because I want to buy more. Right?
Absolutely. So, well, Kenny, it's great talking to you again, folks. Kenny is the Chief Market Strategist at Slatestone Wealth. You're going to have the chance to see him at the Paris, Las Vegas for our Investment Masters Symposium. Runs from August 8th to August 10th. So please check the link out in the description below if you want more information. And Kenny, thanks again. Oh, and don't forget, everybody, Kenny's on Substack. He's got a great newsletter there that gives you all the market thoughts, as well as some nice recipes, if I'm not mistaken, right?
You are correct. KennyPolcari.substack.com.
Excellent. All right, Kenny, take care. Thanks for taking some time out.
Yeah, it's a pleasure.